prediction was if we have a mania phase, it'll hit the upper bound because that's what all the mania phases are hit. And the upper bound currently, earlier this year, it was tracking. You didn't know what it would end up at, but it was tracking it between 200,000 and 400,000. And now we're into December and it's $216,000 right now. That's the upper bound, but we haven't had the mania. So like we're actually right in the middle of the zone between the bottom and the top.
Well, I mean, the thing I take out of that is where you said it's, these things don't happen in mature markets. We've now got a mature market. And if you want those kind of crazy wins, you can go into the altcoin market. There are always going to be these fast moving upswings on new altcoins, but Bitcoin is now a mature market. And I've always said, Willy, I've been saying all year, I want the cycle to end. I want the cycle to break because I want the market to mature, because these massive fluctuations in price, I think they hold back entry for certain people. I think it makes it more difficult for people to come in. So a maturing Bitcoin market, especially as we now have nation states, I think that's a good thing.
Yeah, I agree. I think that, like the kind of things we saw in 2017, which was, it started earlier than 2017, but that particular cycle was a 100x on Bitcoin. And of course, we weathered immense volatility. And, the average person on the street will think 100x in that time frame. It's just stupid. It's like there's something wrong with that. Like it's a scam. But they're much more interested in lower volatility and something that's a reliable gain. And I know that, particularly family offices in the US, they're much more interested in the gains that Bitcoin promises to make, not what it has made, which has been higher, but it promises to make roughly currently about 110% annualized per year if you follow the trajectory that the stock to flow model projects going forward. It's 110% annualized, right? So that's pretty high, and it's believably high as well. Like you can do that in exotic instruments, but the downside risk is very, we've just pulled back. How much is it? Mid 30%, like in a matter of weeks. And so I'm not so interested in experiencing the downside. They'd much rather have less risk, and they don't care necessarily about the 100x. It's really about the risk-adjusted returns. And particularly, you can put yourself in their shoes. You're managing 100 million or multiple hundreds of millions. You don't want to see your portfolio swing downwards like that. Well, retail can handle that if they're hardened hodlers, but once imagine losing $30 million over 3 weeks in a particular drawdown. If you're fully exposed to Bitcoin, that's not really on managing that size of money. So as this thing matures, I think I agree. It's like it becomes more attractive, and I mean even Michael Saylor said that that like it reached the high net worth want to buy the top, like that. They don't want to buy Bitcoin when it's like a $4 billion asset class. They want to buy it when it's above $1 trillion because it's sufficiently de-risked. Whereas we just want to buy low.
Yeah,
right? We want to buy it at $1, right? But these guys are very sophisticated around risk. And honestly, if you bought Bitcoin at $1, the risk was unquantifiable. Really, there was no way to quantify that risk. You could do it numerically, like, wow, that's the volatility of my returns is really like off the charts. But like the risks that you can't quantify is, will this thing not be hacked? Will the government stamp it out? All sorts of stuff you can't even think of. Like it's very hard to quantify. So it's getting into that region where, if you look at El Salvador coming on board, it's obviously been sufficiently de-risked for a nation state now. It's had 12 years or maybe 13 years. It hasn't been hacked. The protocol runs, so that's good. Volatility is sufficiently low for a nation state to now adopt it. Still pretty high, but like the upside is good. So yeah, I mean, like, it's a different realm now, and it's good for, I think, geopolitical um, sort of that sort of game, which is, with so many people in retailer and in that like DG, and I want 100x, which is fine. And the Bitcoins are sitting here talking about this is hard money, and we're at a geopolitical level. We can really impact the future of the world as it goes forward. They're two different things. One's number go up like insane for myself. The other is impact, geopolitical impact. And I think they are two different things. Yeah.
Yeah. So are we giving Dan Hill the credit here? Are we saying that his super cycle theory might be right? I'm trying to remember what he said. He said it'll be a super cycle if we don't have a blow off top 80% drawdown. I think he said even if we drop like 50% but carry on growing, essentially we're in a super cycle.
Okay, all right. Yeah, I think he's right then. I didn't read the article, honestly. I just gather from conversation. But I think that's right. I would have done it on not only to drawdown, but I'd do it on time to recover. So, like a 80% or drawdown, you could actually do that through a liquidation crisis, and it bounces back up because some exchange, fails and it pulls everything else down, which has happened. Like Coinbase screwed up at one point, and it's part of the index prices for the futures exchanges. For the perpetual swap contract, which is the most liquidly tradable contract.
What happened there?
So effectively, Coinbase, that price started dumping because they were inundated. The API started failing, whatever. But I know that many people couldn't buy the dip, and so the price kept coming down. And because Coinbase is one of the exchanges that, when you do a perpetual swap contract, you need to know what the price of Bitcoin is. And so you get a basket of exchanges, and then you run some sort of average over those exchanges, and that gives you the price of Bitcoin. And the price of Bitcoin on spot exchanges throw their indexes versus what it's trading around on the derivative markets. That differential dictates the funding rates for long and short. So once you screw with the index, so suddenly Coinbase, which is a big part of that basket, started dumping because they had a bug or some overload and people couldn't buy it. The whole index got out of whack, and then so all the perpetual swap guys, the guys on derivative markets, going, whoa. We're trading way too high above what the real price of Bitcoin is. No, it's the broken price of Bitcoin because Coinbase had a bug. And so they all started selling down and put immense sell pressure. So the whole thing got out of whack, and we went into a downward spin until, someone bought the bottom and Coinbase fixed the bugs or got their systems back online. So that's how fragile the ecosystem can be. And sure, you could get 80% drawdown and then it'll recover very quickly. It's more of this longer, it's like drawdown plus length of time to recover, because the long time stuff is real. This stuff is just, it's kind of like Wall Street, why they have that big red button to stop everything because the bots have gone berserk. This is kind of similar.
Damn. Well, it's been an interesting year. We didn't get these 100K like we thought. Well, I mean, I think people started even more bullish, expecting maybe 250, 300K. We didn't get the 100K. I've crushed my bet with HODL. I mean, I don't think we're going to get to 300K in 8 days. I think I've won that bet. And do you know what? I offered him a double the quits bet a couple of months back. I turned around and I said, I'll tell you what, I've probably won that bet. I'll go you double the quits. It won't break 100K. And he was like, ooh. And I think I would have won that as well. But obviously, we didn't get to do it.
He didn't take it.
He didn't take it. Yeah, I thought it was a good bet. I was like, what's the lowest I would go? And I thought maybe 85, maybe 85. Because when we got up to 69, I thought, here we go. We're going to push to 100 now, but it didn't happen.
No, it didn't.
Yeah. So what do you think about next year then? And has this changed the way you analyze the data? Are you having to rethink everything?
Everything changes. On that topic, what the top is, currently the model says 215, right? But that's not, we're going to be at that price. It's that that's the upper bound price for Bitcoin using this model, and that you only get that on a runaway parabolic mania phase top, which we never got, and really, I don't think we'll get that again. So I don't think, like, if we, like, this is, the prediction was, if we have a mania phase, it'll hit the upper bound, because that's what all the mania phases are hit. And the upper bound currently, earlier this year, it was tracking, you didn't know what it would end up at, but it was tracking it between 200,000 and 400,000. And now we're into December, and it's $216,000 right now. That's the upper bound, but we haven't had the mania. So, like, we're actually right in the middle of the zone between the bottom and the top, and it's very cool right now. But having said that, to answer your question, going into next year, it's I think one thing we're going to learn is that the 4-year cycles are dead. And then we'll probably have to decide whether it's lengthening cycles, which I don't think. Lengthening cycle, by the way, is like this idea that there's more and more weight in the system. So these oscillations of bull, bear start to be, bigger momentum and longer time frames. Maybe we won't learn that this year.
You don't think that's possible?
No, I don't think that it makes sense. I think that like on fundamentals, we have a 4-year gravity orbit around the halvening. So that's the mining infrastructure. So that's like one wave every 4 years. And then we have a macro cycle correlation, which is to traditional assets, which are like, we have bull bear markets every is it 10 years or so? Mm-hmm. Roughly, it's kind of random. It could be up to 14 years. So that's another that's another sort of wave of like a decade-long cycle, and that's getting a gravity pull to the correlation to traditional assets. And then you have, basic demand and supply of, the like we had earlier this year, where there's a lot of FOMO, and then that cooled off, and all of that FOMO and then cool off has its own cycle within our industry, which creates a wave of demand and supply. And that's different. So you have all these different waves on top of each other. And so I think that the main one is the halvening, and the other big one is correlation to traditional assets. So we're about to escape the gravity of the halvening, and we're going to enter a new orbit around traditional assets. And that is like a decade-long cycle, and so it's binary. I think it's binary. We go from 4 years to a correlated asset to traditional, and we have little wavelets, which are our internal sort of infrastructure, like pulses, which are like, looking at this, it looks like every six or 8 months that's happening right now. So yeah, I think it's like binary. We go from 4 years to 10 years.